Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 23rd, 2017. It is noon Eastern Time as I'm starting this video, so the markets are open. And I wanted to do a little bit different video. I normally cover either the broad markets, certain sectors such as gold or whatever sector is standing out to me at the time in these videos. Sometimes I'll do a video on long or short trade ideas. I wanted to give you guys one of my watch lists. I have literally dozens of watch lists. And the one that I'm going to go over today, I'll just rifle through these stocks one at a time. I'm sorry, these are all ETFs, I should say, that track either a sector or a broad market or an industry. Some are ETFs, some are actually the industry or sector itself. So we're going to go through these relatively quickly. This helps me paint the big picture because when trading, I use a top-down approach, meaning I look at the broad markets, formulate an opinion, and then I also take a look at all the sectors, various sectors. So this list, although it's not all-inclusive of every sector out there, it's just some of the ones that I watch. And if those that I see any interesting technical developments, we're starting out here. I happen to have the list sorted right now at this point by the sectors that are down the most. In other words, I sorted the column by the percentage gain. So as we go down this list, unless things change, you'll see we'll start moving from sectors that are trading in the red today to those that are in the green. So I'm not picking favorites here. Just wanted to give you guys an overview. Let's dive into the charts. This one is XME. This is you can see here the names are down below: Spiders, S&P, Metals, Mining, and ETF. So this has similar to GDX, except it has more of the industrial metals is really what you're looking at here. Copper, iron, aluminum, things like that. And you can see a pretty clear breakdown. This was a pattern I was watching most recently. We've had a series of divergent highs. We had a divergent high at this point as I put the crosshairs. We did have a little blip, and then from that point we moved up in this bearish rising wedge, a very, very well-defined uptrend line, which you can see in the form of technical analysis. Is just a beautiful chart because you had a breakdown yesterday. And then we back tested it again today. You can see the candlestick. Look at that wick. Just boom, right on the trend line. And then bam, a big red impulsive candlestick. So this is quite bullish. Quite bearish price action, especially this big red impulsive candlestick. That's what you want to see on a breakdown. You don't want to see prices just limp on through, trade there, because sometimes they'll snap back up within there. So anyways, doesn't paint a good picture for the industrial metals. And that might have carryover to the countries that are heavily dependent on metals and mining, resource-oriented countries like Australia, Canada, a lot of South American countries, etc. All right, let's move on to the next one. Speaking of industrial metals, this is the copper ETF JJC. There you go. You can see it there. A couple different draws. I could move this trend line around, but you can see the bottom line is I have a wedge here. Again, these charts are not fully annotated because I wanted to get this video out quickly. I think there's a lot going on today. Pretty sharp negative divergence at the high. That was also a resistance zone that copper failed at, or at least the ETF JJC. Breakdown, back test, snapped back within the wedge. As I mentioned, if you want, you can extend this trend line this way a little bit because you certainly capture a lot of reactions there. But most importantly is this big red impulsive candle. Again, no coincidence. I just went over the industrial metals ETF, which of course copper and copper mining stocks, they're all part of that. So near term and intermediate term, because of the size of those wedges, I would favor more downside. I think JJC is likely to come back into about this $28.90, call it $29 level. Gas, there's a lot of natural gas ETFs. I like to use spot natural gas prices as well as natural gas futures because these ETFs are just, they do over time a horrible job of tracking. I mentioned the other day in the trading room going long natural gas, and so far so good. It's off the bottom a little. It's not reflected in this GAZ chart, so I'm going to move on there. DJUSSR, this is the U.S. Dow Jones U.S. Railroads Index. Fairly well-defined trend line here. We had one breakdown, and we snapped right back above that trend line. But in trend line drawing, I look at the number of reactions. I see 4 or 5 back here. quite a few reactions there. That one little brief fake down or false breakdown, push back up. Now we're testing that trend line as we speak. So I really don't have a strong opinion there. Just keep an eye on that trend line, because if that breaks, there's a good chance that the railroad index will go in and at least test the top of that gap right here, this large gap. And more so, I'd probably favor a backfill the gap. That's also very nice horizontal support. You can see a couple reactions. So there's your target down there, and that's just the index. You could take a look at the individual railroad stocks. It also dovetails with IYT, which is a transportation index, which also has trucking, airlines, other things in there. So this is just one component of the transportation index. PBE, I'm going to get to a different biotech chart. I don't like this chart. I do see some developments in XBI, which is the biotech ETF that I follow the most. Semis, you guys know my thoughts on semis. Unless you're new to the site, this is probably one of, if not the most bearish sectors right now. We're just right now on that line. There's that yellow, what I call alternative uptrend line, and then here I have this primary white uptrend line just below. The white uptrend line comes off the February 2016 lows, where the yellow trend line comes off. There was a brief intra or one day breakdown. We snap back up above the primary uptrend line, so that's why I have these two alternative trend lines, either one of which, and certainly the latter of the two, would be your confirmed sell signal. And personally, I'm pretty aggressively short the semis already. To me, the breakdown seems imminent at this point. Let's continue on. XBI. Okay, here's the biotech ETF. I've updated this one, not in recent days, but quite a bit in the past. This was what I've been watching for a long time, this large symmetrical triangle pattern defined by this yellow downtrend line and this yellow uptrend line here. We've had numerous reactions on it. Finally, prices broke out. When they did break out, we came in, we made a back test. It wasn't a very convincing breakout. I pointed the breakout. At the time I pointed that out on the site, I also pointed out it wasn't very convincing. But we back tested successfully, moved higher, and then I pointed out this would be a key resistance level 69, which you can clearly see we failed at. There were a few intraday attempts to get above it, and we failed each and every time, and we've been moving impulsively lower since. You guys know I like to look at the 60-minute charts to really hone in on things. I noticed this the other day. We had a pretty clean bearish rising wedge pattern defined by these two uptrend lines, a breakdown with impulsive selling. We've come to the first support level that I have, and I should add, just to clarify, and actually that's where we stopped. See this reaction here? We had a reaction highs here, and maybe some back there. So this is certainly the first support / target zone. We hit that, we bounced a little bit. So if you are short the biotechs, the wedge certainly projects a bigger drop. The projection of the wedge, you take the widest part here, which I just did, add that to where it broke down, and that would project down to right here. Look at almost perfectly to that support level / target I have there. So, and if keeping in thoughts my opinion on the broad market, I do favor more downside in the biotechs. And just recently took a small short position on that. I like to short LABU, which is the 3-time bullish biotech ETF, because that thing it's notorious for decay. So if I can tuck that one away, hopefully for a few weeks or a few months, I'll benefit from both the move down as well as the decay suffered by because this is a very volatile sector. So that 3-time leverage ETF has horrible decay over time. All right, that's biotechs, PGJ. This chart, and I'll tell you, the Chinese markets in general have never failed to amaze me. I guess it's the traders over there and just what they see. They love trend lines. I've never seen a market that is so quote-unquote tradable to the technicals, because when I look at this chart, what stands out to me are just a series of mostly bearish rising wedges. You can see we walk up, there's trend lines. This one broke. Then you had this minor trend line set up. We had a divergent high right here. If I hit the crosshairs, I wish that pop-up box would go away. I can make that happen. So there you go. There was your divergent high. You can see the PPO down here, RSI. We had a little flagging type pattern. So That's it. I mean, simple but effective. You look at these uptrends, wait for the trend line breaks, and you get a correction. Bearish rising wedge, confirm with divergences. And the corrections are nearly as powerful as the moves up, and they're usually more swift. You know, stocks typically fall faster than they rise. So, I mean, the pattern is so clear sometimes, and you get these little smaller wedges after the big ones is more like a bearish pennant or a bear flag continuation pattern, and you wait for a break, and there it is. I will point out, divergence is nice to confirm a wedge, but it is certainly not necessary. Case in point, we look at a couple here. We didn't have any divergence at all on this one, nor on that following little wedge there or flag pattern, and we still had a correction. We did have divergence here. We did have it on a couple of these. We didn't have it on this one, and we don't have it here. However, we do have a wedge with a fairly well-defined trend line, so maybe we want to push higher. Your sell signal will come if and when we get a break below this trend line. And that is PGJ, the Power Shares Golden Dragon Halter USX China Portfolio ETF. That's a mouthful. XRT, retail stocks. I've commented on these in the past. Retail spending accounts for, what is it? I don't know, almost 3/4 or so of GDP. This tells me a story that doesn't really mesh with the stock market as a whole. It seems that tech stocks are, I'm not going to compare them to the bubble in 2000, but they are without a doubt what's been driving this run higher, big part of it. And the retail stocks are lagging and still haven't come anywhere close to the highs that they put in back in 2015. So there's a pattern. Here's some trend lines to watch. I don't have an opinion. I'm not long nor short these. I just don't see a reason to be right now, other than maybe some individual names. But we did have a divergent high back here at this high. We corrected. We came back into that downtrend line. So this is really the level to watch, bigger picture, if that downtrend line breaks. And if you're bullish on the retail stocks, you have support right here. You can go long, and not too far below that, you have the uptrend line, which would provide an objective long entry with a stop not too far below. Or you could wait for a confirmed breakdown and short the retail stocks. SMH, again, I already touched on the semis. There it is. This is one of the go-to ETFs. I follow a few of them, and I already went over the semis earlier via the semiconductor index chart. There's those two trend lines, the primary, the white one, and the alternative. We're pinching right now very close to the apex of that wedge. The divergences are very strong, and again, I think there's a tremendous amount of meat on the bone for a short trade, a multi-week, multi-month swing trade, and a move down that I think would be no less than, I think I've quantified it before, 20%. Let me make sure. Somewhere down here, that would be a 10% drop. And if we get down to this level here, which I can easily see, that's about 18 or so percent. So sell signals are still pending. That's why I don't have that as an official trade idea yet. But I am personally short the semis, and will even add some exposure once the breakdown's confirmed. IWM. Let's see. Well, it's not drawn out here, but you can see a divergent high, pretty strong divergences. See the PPO curling down. See the RSI making a much lower high versus this high. And if I move this little shaded box away, I've got a 1,000 lines. Pardon me, guys, we're not cleaning this up. But there's your divergence. So price is making from this point to this point a higher high, with the indicators clearly making lower lows, and that is negative divergence. 60-minute chart tells us a nice story as well. I've pointed out for a while now this sideways trading range. We had a wedge here, a divergent high, and that divergent high did play out for a correction, as did this one. So let's make that clear, that these divergent highs, sometimes you don't get much more than a couple percentage point pullback. They did play out for corrections, but the bigger picture is the corrections were relatively muted, and we've traded sideways for months in this range. Now, the most recent development was a breakout, which at the time I stated, and I still believe will be a false breakout. We had this break above the top of the range. Wasn't very convincing, meaning the volume was not above average. We had a divergent high as well. You can see the negative divergence at the point that the that we broke out above there, and so far we've come back to back test the top of the range. So I have this resistance slash support zone. We're just fighting to hold on, or IWM's just trying to hold on to the bottom of that range. If we move much lower, much below the bottom of this former resistance, now support range, that this up here, the entire breakout right here, will be considered a failed breakout, aka bull trap. Bulls go long when they see a trading range, just as I had said before. You know, the next direction of this range will be a convincing break. Convincing. This did not convince me to the up or downside. The charts were indicating a downside break and still are. And as I often say, fewer things in trading are more bullish or bearish than a failed breakout. So in this case, it was a failed, it could be, if we get back down in here, a failed long side breakout, which then you could see prices quickly move down and break down below the bottom of the wedge. So that's IWM. Bigger, and daily was a bigger picture, and I just showed you the 60-minute chart. Transpose. This is IYT, Transportation Index. I already covered the railroads. Same story as so many things out there right now. Very steep negative divergences. So this one looks like it's going to come back in. Your next sell signal would be a break of this uptrend line right here. And then I don't see, it's a lot of thin air all the way down here to about 154, 155 or so is where you start to see support come in. And we could even go below that. Wouldn't surprise me in the coming months to see us go down to 150 on the transports. TNX, these are treasury bonds. They're just trading in this little range. Just wait and see whichever way this breaks. You know, if there is a pullback in the markets, especially if it's a sharp one, you usually see a flight to safety. And what that means is people buy bonds, money moves into bonds, especially from institutions, as a safe money investment, which then drives yields down. Remember, if you buy bonds, you drive the price up if there's more buyers, which then drives the yields down. So my favor right now, a downside resolution of that pattern. There's my target on TNX around 21, 23, and then we'll go from there. Maybe we come back and visit this longer term downtrend line that goes to the left of this 2-year chart. XAL, here's airlines, another component of the transportation index. Story on those, we have a fairly well-defined uptrend line, as you can see here. We broke down recently, back tested, and have since turned back lower. So not crazy about the outlook for the airline stocks. There's a downtrend line to watch. We have numerous reactions so far, so we're sort of pinching. Let's just watch this one and see what it does. XOP. This is the S&P Oil and Gas Exploration and Production ETF. There was a wedge here, or an uptrend line that was broken. A divergent high, a pretty powerful divergent high here at this point, right here. You can see the divergences down below. And so far, those divergences are playing out. And we're moving down in a pretty tight descending price channel. And this is support right here, a pretty significant support level. We're starting to crack below it. So what that does, if this continues to play out, and I suspect it will, I favor more downside based on the scope of these divergences. And your next support is down here. I'll give you that number in a second. And then possibly down there a little bit above. I need to move that line up. Let me give you the numbers right now. Put up numbers on this. This is 35.25. Let's make it a little brighter for you guys to see on YouTube. And this one needs to be moved up, tighten that up to about right there. Those are my downside targets should XOP continue lower. These are investment brokers. You know, I did a video today on the financial sector, and these guys will move in line with the financial sector. These are the brokerage stocks. Negative divergence looks very similar to XLF, so I'll just tell you I expect a downside break, and I'm bearish on those guys. MU is the Van Eck Vectors Agribusiness ETF. So these have not agricultural commodities, but the companies that are in that industry. And it's been doing well for the last year. Throughout 2016, it's been in an uptrend, but you can see a very well-defined uptrend line. Let's color that yellow so it stands out. This is what you need to watch. If that breaks, we do have negative divergence at the most recent high. Hit the wrong tool there. try to draw the divergence. So we had divergence here, and that we made a new high, and the divergence has become a little bit steeper. We were very overbought here. Try to draw these out. Some extreme overbought readings. But as of now, it's in an uptrend. You can see support here. That's this line. Sorry, guys. That's at 53.12. And if we break the yellow trend line, then the first support comes around 51.10 or so. All right, how am I doing on time? 20 minutes. Okay, let's go a little faster. NASDAQ composite, bearish rising wedge, negative divergence on the PPO and MACD. And as I've mentioned, the most overbought readings that we've seen in, if I'm not mistaken, 20 years or more. And I think we're even more overbought on the daily than we were leading into the dot-com bubble, if I'm not mistaken. NDE, same story. I've gone over the broad markets in depth, so I won't spend any time on them here. I just wanted to get to these sectors. XES, I already covered XOP, very similar chart. XLB, these are basic materials. Looks like a pretty clean bearish rising wedge to me. The white lines there, here, and here. We're getting close to the apex. So my price target on this one, should that wedge break to the downside, 49.65. Let's draw it out for you here. And let's see, something like this. Now that's my minimum initial price target. At this point, that's all I can see. We just have to watch where the broad markets and XLB goes. But if we do get there, it'd certainly be an objective level to cover, maybe game a bounce if you're a swing trader. And if and when that level goes, you can see the additional downside targets. A lot of these are lines I've had on this chart for years. That doesn't mean these lines are targets at this time. They're just previous support and resistance levels in the past. So these are the ones, these first three that I'm looking at now. Again, if this bearish rising wedge breaks, which it appears to me likely. You can see the divergences, and now they're drawn out for you. NDX, again, covered that. Detail, QQQ is just the tracking ETF for NDX. You can see we're walking the line on the Qs, 60-minute chart. That's that minor uptrend line I was watching. We've already broken down there. SPEW is the equal weighted S&P 500 index. UUP is a dollar index. Uptrend line, breakdown, back test. So maybe the dollar pulls back in. I don't know. I'll have to do the dollar in another video. That really warrants its own coverage. XLF, I already did extensive video on XLF this morning, making a bearish case, so you guys can take a look at that. XLK, here's the tech stocks. Now, the tech stocks, you guys saw I did a video of the top 10 components of the NASDAQ 100 the other day, although I paused the video accidentally and missed these top holdings, Apple, Alphabet, and Microsoft. I did put up the static charts on Apple, and I'll try to get to those Alphabet, Microsoft soon. But you can see this almost mirrors the top 10 holdings in the QQQ. So in other words, to trade the Qs and XLK to be long or short both in your portfolio, you have a tremendous amount of overlap. So where one goes, the other's going to go. That's my point. Dollar index, I already talked about that a little bit. S&P 500, I've covered that extensively recently. FXI, that's just another Chinese ETF for China. Have just different drawings here. Not a strong opinion on that chart. There's the SPY again. Covered that. IYR, REITs. They've already had one heck of a correction. It was pointed out here, bearish rising wedge with a divergent high. That's defined by these two white lines, this white uptrend line and this one here marking the divergence. Breakdown back test, TA 101, tried another thrust, came out, challenged that high that we had on the back test and failed and had a heck of a correction. So these were quite oversold. They fell to a very solid support level. Look at all the reactions from below and above, and naturally bounced off that level. Where we go from here, I don't have a firm opinion on these guys. They've already cleared out a lot of the excesses with that correction, so I just leave the REITs alone right now, barring any individual names. MUB, Muni Bonds. You guys might recall back in 2016, I posted right around here a post something to the effect of Muni bombs pending, warning that there was a a high probability we're going to see a pretty big correction in the municipal bond sector. And my warning was more so, here's the dividend yield at this point in time. Now remember, that yield was lower. When prices go down, yields go up on bonds. And I warned, and that proved to be correct, right before we hit that top. We're going to see a hefty correction. Now from the peak, municipal bonds dropped 7.6% according to this measurement, which, as I stated, wiped out not months, but literally years of dividends. So people that thought they were in quote-unquote safe harbor, safe money investment because they had municipal bonds, have now negative returns over the last few years. Anybody that bought, around those highs there, all the interest and dividends, even if you sat here, even if they don't drop any more, which they very well may, it would take years at the current dividend rate to recover the losses that you've had in just the last few months. We got quite oversold. I wouldn't short these bonds. In fact, I really don't care to short muni bonds or dividend paying instruments. Excuse me, that post was more so just as a heads up for those of you that might have muni bonds in your investment portfolio. Okay, moving on, only a few more to go. This is EEM, the Emerging Markets ETF. As you can see here, just a series of uptrends and downtrends. We had a primary downtrend line, a divergent low. I must have had the MACD up at the time, which is similar to this PPO, so I'll have to add the divergence. They're not all drawn out on the PPO that I'm using right now. Hard to get it there. There it is. So you had a divergent low, which is bullish, downtrend line breakout. And then within that, so that's the larger pattern. See how the size and scope of this bullish falling wedge. And then you had this smaller bearish rising wedge within there, which led to a correction. As I always say, that typically, not always, but typically the scope or duration of a move following a bullish or bearish wedge breakout is commensurate with that of the wedge. I already have gone over measurements, which are usually the width of the wedge. So you measure the widest part of the wedge, and that gives you an approximation for the expected move. Now this was a much wider part here. Let me use my measuring tool here. Let me block that out. So if I take this trend line now and go to the widest part of the wedge, add it to where the wedge breaks out, that gives you the projected move. And you can see we're a little bit above that right now. And so the emerging markets may have run their course. Either way, technicals work well. Bearish rising wedge, there was a divergent high, and you had a correction. So this is how I trade. Trading wedges, bullish or bearish, makes up a large part of my trading, and they're fairly simple but highly effective. And correction, but then the bigger picture again was this long-standing, much more powerful divergent low. So we had a correction, we continued to move higher. Another wedge, there was divergence at the high, confirming that wedge. You can see it. Correction ended there, and we've been walking up in this uptrend. I don't see any divergence at this point. It's just a trend line to watch if you're currently long EEM. But I will say we're very overbought. These are other things that I look at. The RSI is pretty extended, or recently was. Last time we were overbought was right here. We didn't correct right away, but we had a series of lower highs. This is negative divergence, and then finally the correction played out. We're overbought here, same story. So again, this is what says the risk reward isn't very favorable. The upside is most likely limited when you're that overbought. So I would stay away, and if you're looking to short, wait for confirmation, wait for a trend line break. TLT, government bonds, this is the bond ETF. I already shared my opinion on one of the TNX or TYX, which are the rates. They're sort of in this pattern. You just have to watch these trend lines, see which way this one breaks. And again, I already shared my thoughts earlier in the video. The euro, this is how it's been trading. Divergent low, which was bullish. I was calling for a rise in the euro versus the US dollar. We got that, ran right into that key resistance level I had. Pulled back. There was a minor uptrend line here. We broke that down. These are levels I've had on this chart for a long time. These weren't added after the fact. They were here before. We came down, hit this S2 level, bounced right up to S1, which is really S1R1. Former support then becomes resistance. Came back to S2, and that level's holding so far. You can go back, look at all the reactions to the left, all the reactions back here. So that's a key support level. That needs to hold. And again, currencies weren't a whole nother video in itself, so I won't get into that. I'll just tell the euro is at support. And if I had to take a quick guess looking at this chart, I would say that support level probably holds. But again, I'll have to do a separate video on that. XLE, I gave a scenario not too long ago, I think within the trading room, that we might probably would come back into this level, which we did. That's a key level, 71.62. You go to the left, you see a lot of reactions to the left of that line. So this is a pretty key support level. If it goes, the next support is this purple uptrend line. After that, I don't see a whole lot to down here, and that's about $64 this level. XLP, they've been taking off. Consumer staples, these are defensive stocks. This tells me institutions see the same red flags that I see in the market, because somebody is certainly buying consumer staples with conviction, and that's probably institutions. Consumer staples, those are the products you need: soap, bleach, laundry detergent, things like that. That thick or thin, throughout a recession, you continue to buy those items. Therefore, they're considered recessionary-proof stocks, and with the stock market at all-time highs, all of a sudden you're seeing a ramp into these consumer staples. This may be a red flag, a little canary in the coal mine there, folks. Gold, gosh, I've updated gold in the mining stocks so often lately. Let's not get into that in this chart. In this video, I mean. XLU, utilities, here's another defensive sector, guys. Utility stocks, same story. I don't care how tough times get, you might stop. You might put regular unleaded instead of premium in your car. You may not go out to the movies as much, but what you're going to do is you're going to pay your electric bill every month so your power doesn't get shut off. So these are defensive issue companies, and as you can see, there has been quite a bid under these lately. Again, why is this happening with the stock market trading at all-time highs? Why is somebody, most likely institutions, bidding up these defensive sectors? Well, your guess is as good as mine, and my take is that they see that things in the horizon, at least in the near future, the outlook for the market may not be so good, and/or the economy. GDX, again, covered it ad nauseum in a lot of posts within the trading room and on the front page. And finally, somebody asked me today about USO within the trading room, and I was clear to state I just don't have an opinion. USO has traded in an unusually tight, almost unnatural sideways trading range for months now, going back to early December. So I can't extrapolate much from this chart. I did just pull that uptrend line there, but we need to break out of this trading range. I just can't. You can't squeeze blood from a stone. I can't extrapolate any useful information from a chart if a security is in a multi-month sideways trading range. Indicators start to flatten out. That doesn't give you any direction there. You can't see any divergences, money flows, nothing really works. You just have to wait and see which way this goes. And my take, if I look at a chart and I can't make a clearly bullish or bearish case, move on to the next one. There's plenty of fish to fry out there, and I don't try to force a trade. All right, this has been Randy Finney with the Right Side of the Chart, and I hope you enjoyed it.